Gold prices are trading at historic highs as we approach the end of January 28, 2026. This is no longer a short-term rally or a speculative spike. Gold is now at the center of the global macroeconomic conversation. Investors across the world are reassessing risk, currency stability, and long-term value preservation. In this video, we will take a structured, data-driven look at the forces shaping today's gold market. We will begin with the global macro environment. Then we will narrow our focus to the United States. Finally, we will address the growing discussion around $6,000 gold, not as a prediction, but as a signal of deeper systemic stress. As of today, spot gold is trading above $5,200 per ounce. This price level would have seemed unimaginable just a few years ago. Yet here we are. The question investors are now asking is not how gold got here. The question is what this price is telling us. Gold does not move in isolation. It reflects confidence, or the lack of it, in the financial system. It reflects currency strength, interest rates, debt sustainability, and geopolitical stability. When gold rises sharply, it is rarely about gold alone. It is about everything else weakening at the same time. Let us begin with the global backdrop. The world economy is operating under elevated uncertainty. Growth is uneven across regions. Inflation pressures remain persistent in key economies. Sovereign debt levels continue to rise. Fiscal discipline has become politically difficult in many countries. These conditions form the foundation of gold's long-term strength. One of the most important drivers is the US dollar. The dollar has been the dominant global reserve currency for decades. However, that dominance is increasingly being questioned. Persistent fiscal deficits in the United States are weighing on confidence. Rising interest expenses on U.S. debt are becoming a structural issue. As the dollar weakens, gold becomes more expensive in dollar terms. This mechanical relationship is simple but powerful. A weaker dollar almost always supports higher gold prices. This is not just a domestic issue for the United States. Many countries hold large reserves denominated in U.S. dollars. As the dollar loses purchasing power, those reserves lose real value. Central banks are responding rationally to this risk. They are diversifying away from dollar exposure. Gold plays a unique role in this diversification process. It carries no counterparty risk. It is not issued by any government. It cannot be devalued by policy decisions. For central banks, gold is a form of monetary insurance. This brings us to central bank demand. Central banks have been net buyers of gold for several consecutive years. The scale of these purchases is historically significant. Much of this demand comes from emerging and Eastern economies. These countries are actively reducing dependence on the U.S. dollar. Unlike speculative investors, central banks buy with long-time horizons. They are not concerned with short-term price fluctuations. Their purchases remove physical gold from the open market. This reduces available supply. It also creates a strong structural floor under prices. Central bank buying is one of the most underappreciated forces in this market. It does not generate headlines every day, but it quietly reshapes the supply-demand balance. And it reinforces gold's role as a reserve asset. Another critical factor is monetary policy. The Federal Reserve remains at the center of global financial conditions. Markets are highly sensitive to every signal from the Fed. The current policy environment is deeply uncertain. Inflation has not fully stabilized. Economic growth is slowing. The Fed faces a difficult balancing act. Tighten policy too much, and recession risks increase. Ease policy too soon, and inflation could reaccelerate. This uncertainty benefits gold. Gold thrives when policy clarity is lacking. Interest rates are particularly important. Gold does not yield interest or dividends. When real interest rates fall, gold becomes more attractive. If markets anticipate rate cuts, gold often moves higher in advance. Expectations matter as much as actual decisions. Forward guidance from the Fed is now a key driver of price action. Even small changes in tone can move markets. This sensitivity reflects broader uncertainty in the system. Investors are searching for stability. Gold offers that perception. Geopolitical risk is another major contributor. The global political environment remains fragile. Trade tensions persist. Regional conflicts continue to escalate unpredictably. Diplomatic solutions remain uncertain. During periods of geopolitical stress, risk assets often struggle. Gold historically performs well in these environments. It functions as a safe haven asset. Investors turn to gold when trust erodes. This behavior is deeply ingrained in market psychology. Gold has preserved value through wars, crises, and regime changes. That historical memory still matters. In times of fear, investors prefer tangible assets. This psychological component should not be underestimated. Markets are driven as much by perception as by data. Now let us focus on the United States specifically. The U.S. gold market reflects both institutional and retail participation. Institutional investors trade gold through futures, ETFs, and derivatives. Their activity drives much of the short-term volatility. These investors respond quickly to economic data releases. Employment reports, inflation data, and GDP figures all influence positioning. Many funds currently maintain bullish exposure to gold. This reflects expectations of continued macro instability. Risk management strategies increasingly include gold allocations. Gold is being treated as a core portfolio component. Retail investor behavior is also changing. More Americans are buying physical gold. Coins and bars are seeing increased demand. This reflects declining confidence in traditional assets. Stock market volatility has reinforced this trend. Rising living costs have also played a role. Households are more sensitive to inflation. Gold is perceived as a hedge against purchasing power erosion. This perception fuels steady demand. Retail demand adds resilience to the market. With these forces combined, gold has moved decisively above $5,000. This level carries symbolic weight. It marks a psychological threshold. It also invites discussion of higher levels, most notably $6,000 per ounce. It is important to be precise here. $6,000 gold is not a forecast. It is not a target. It is a thought experiment. It represents a question about system-wide confidence. What conditions would justify such a price? Likely a deeper erosion of trust in fiat currencies, possibly aggressive monetary easing by central banks, or a major geopolitical shock, or a combination of these factors. A move to $6,000 would not be about supply shortages alone. It would reflect a shift in collective belief. Belief about money, belief about debt sustainability, belief about financial stability. Such a price would signal stress, not prosperity. It would indicate that investors are prioritizing preservation over growth. That shift would have broad implications for currencies, for equities. However, there are also risks to the upside narrative. Gold is not immune to corrections. A stronger than expected dollar could pressure prices. A hawkish Fed pivot could raise real yields. Easing geopolitical tensions could reduce safe haven demand. Markets rarely move in straight lines. Consolidation phases are normal. Pullbacks are part of healthy price discovery. Long-term trends are built through volatility. Understanding drivers matters more than short-term levels. The discussion around gold today reflects broader unease. Investors are questioning long-held assumptions about growth, about stability, about monetary credibility. Whether gold reaches 6,000 or not is secondary. The fact that the discussion exists is meaningful. It reveals uncertainty embedded in the system. It highlights shifting priorities, and it underscores gold's enduring role. This is why gold deserves serious analysis. Not hype, not fear-mongering, but disciplined evaluation, based on macro fundamentals. Now we want to hear from you. How do you interpret current gold prices? Do you view them as justified by fundamentals, or as a warning sign? What do you believe is the most important driver? Is it the dollar, the Fed, geopolitics, or investor psychology. Share your perspective in the comments. If you found this analysis valuable, please like the video. It helps support serious financial discussion, and it helps the channel grow. Subscribe for continued coverage of gold and global markets, and enable notifications for future updates. Gold is telling a story. The question is whether we are listening. Thank you for watching. We appreciate your time and attention. Stay informed, stay analytical, and stay disciplined. We will see you in the next video. Until then, manage risk carefully and stay focused on the bigger picture.